The Market's Illusions and the Reality of Value. Benjamin Graham insisted that before anyone attempts to invest, they must confront a brutal truth. The market is not a place of logic, it is a theater of illusions. Prices may look precise, flashing confidently on screens as if they represent objective truth, but beneath that surface lies a chaotic battlefield driven by emotion, impulse, and mass psychology. What seems rational is often nothing more than a collective hallucination. To expose this madness, Graham introduced the unforgettable character Mr. Market, a figure who embodies the emotional extremes of millions of investors. Picture him vividly. A frantic man in wrinkled clothes, his eyes darting around as if he has just witnessed a disaster or a miracle. Every morning, without fail, he bangs on your door. Some days he is euphoric, overflowing with confidence. He insists that your shares are treasures worth far more than yesterday and urges you to buy more before you miss the opportunity of a lifetime. His voice trembles with excitement, his hands shake as he waves his price sheet in your face. But the next morning, everything changes. He returns shivering, panicked, his breath uneven, convinced the world is collapsing. "Take my shares," he pleads, offering them for a fraction of their worth. His fear is contagious, overwhelming, almost suffocating. You can practically smell the desperation dripping off him. This is the emotional volatility of real-world markets. Laid bare, unfiltered, unmasked. Yet Graham reminds you of the most powerful twist. You have no obligation to answer the door. You can ignore Mr. Market during his manic episodes and speak to him only when his price, by sheer accident, aligns with economic reality. This single insight changes everything. Behind every dramatic crash, every bubble, every irrational rally lies the same psychological storm: fear of missing out, terror of losing money, frantic speculation, viral rumors, and blind herd mentality. Markets behave not like machines, but like crowds, unpredictable, emotional, and often wrong. Graham recognized this decades before behavioral finance had a name. He saw that the market's short-term movements are little more than emotional noise, but over time, as drama fades and fundamentals reassert themselves, the truth quietly emerges. Intrinsic value, grounded in earnings, assets, and real economic strength, ultimately outweighs illusion. The intelligent investor's task is not to predict the next panic or mania, but to stay calm amid the storm, to observe while others react, and to seize opportunities created by Mr. Market's madness. Because Graham's core message is timeless. The market's moods are illusions. Only value endures. Margin of safety, the foundation of economic survival. Benjamin Graham believed that the single most powerful idea in all of investing, and perhaps in all of economic decision-making, is the margin of safety. To him, it was not merely a strategy, but a shield, a form of intellectual armor forged to protect you from the one enemy every investor must face: uncertainty. Graham argued that the world is far more unpredictable than people want to admit. Companies fail without warning. Markets collapse in days. Entire economies can shift direction overnight. And in this landscape of hidden risks, the margin of safety becomes a lifeline, something that stands between survival and ruin. Imagine walking across a rope bridge stretched over a canyon. Would you cross it if the ropes could barely support your weight? Probably not. You would want the bridge to be strong enough to hold several times your weight, because if anything goes wrong, you need a buffer. Graham's margin of safety is that buffer applied to the financial world. For investors, it means buying assets at a price far below their intrinsic value. If a company is worth $100, but you can buy it for $60, you have a $40 cushion. If bad news hits, you still have room to breathe. If good news comes, your gains multiply. For businesses, it means keeping enough cash reserves to withstand recessions, supply chain disruptions, or sudden drops in revenue. For individuals, it means saving more than you think you need, preparing for the unexpected, lost jobs, medical emergencies, or economic downturns. When crises arrive, those with no margin of safety panic, sell everything, or collapse under pressure. Those with strong reserves, however, not only survive, they capitalize on chaos. History's most legendary fortunes were built not during stable times, but during storms, by people who prepared for them long before they came. Graham emphasized that the margin of safety is not a prediction tool, it is a survival tool. It acknowledges that humans make mistakes, markets misprice assets, and the future is unknowable. No one can predict recessions perfectly. No one can forecast stock prices with certainty. But everyone can prepare. What makes this principle so powerful and dramatic is that it flips the psychology of investing. Instead of chasing excitement, the intelligent investor seeks protection. Instead of betting on optimism, they guard against catastrophe. And in guarding against catastrophe, they place themselves in the best position to profit from it. Graham's message is simple but profound. Growth is optional, survival is essential, and the margin of safety is the only reliable path to both. Intrinsic value, the compass in an uncertain economy. At the heart of Benjamin Graham's philosophy lies a single unwavering truth. Every asset has an intrinsic value, a real worth grounded not in market mood but in economic reality. Yet this truth is often hidden beneath layers of speculation, hype, fear, and noise. To Graham, the search for intrinsic value is not just an analytical exercise. It is a quest through a fog-filled landscape where emotion distorts everything in sight. Imagine standing on a cliff overlooking a vast ocean. The waves crash violently, rising and falling without pattern. These waves are the market's prices, loud, chaotic, unpredictable. But deep beneath the surface lies the ocean floor, solid, unmoving, unchanged by temporary storms. That depth, stable and quiet, is intrinsic value. It is the true foundation upon which every company rests. Graham believed that while markets may roar with excitement or tremble with panic, the underlying value of a business changes far more slowly and far more rationally. A company's worth is built from earnings, assets, cash flow, competitive strength, and the durability of its business model. These are not things that evaporate overnight because investors suddenly feel fearful. Nor do they skyrocket simply because a crowd becomes momentarily euphoric. Yet most investors behave as if price is truth. They chase rising stocks like soldiers, charging into battle without armor. They flee falling stocks like villagers running from shadows. To Graham, this behavior was both tragic and predictable. People mistake the echo of emotion for the sound of reality. The intelligent investor must see through the illusion. To uncover intrinsic value, Graham advocated for rigorous analysis, studying balance sheets, income statements, cash flow stability, and long-term economics. This is more than research. It is detective work. It is the discipline of separating fact from feeling, signal from noise. And when intrinsic value is known, the investor gains something rarer than profit: clarity, a compass capable of steering them through the most violent storms. Of course, the market does not immediately reward this clarity. Days, months, even years may pass before price and value converge. But Graham insisted that convergence is inevitable. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. When the dust settles, when the noise fades, when emotion collapses under its own weight, value remains. And those who followed it, patiently and rationally, emerged not just wealthier, but wiser. Risk, diversification, and the economics of human fallibility. Benjamin Graham understood a truth that many investors refuse to accept. Even the smartest minds are vulnerable to mistakes. No amount of experience, intelligence, or confidence can fully protect a person from the unpredictable nature of markets, or from the flaws within their own judgment. And so Graham built a principle that stands as both shield and warning: diversification. To Graham, diversification was not a lack of conviction. It was an act of humility. It was a recognition that humans, no matter how skilled, often misjudge the future. And markets, no matter how familiar, can turn vicious without warning. Picture an investor standing on a battlefield. The terrain shifts constantly beneath his feet. Interest rates rise unexpectedly. Political unrest breaks out. Supply chains snap. Scandals erupt. Economic cycles reverse with the ferocity of a storm. In such an environment, placing all your resources into a single position is not bravery. It is recklessness. One miscalculation, one unexpected blow, and everything collapses. Diversification, then, becomes a fortress built brick by brick. each investment a wall protecting the investor from their own fallibility. It spreads risk across multiple opportunities so that no single failure can destroy the whole. It ensures survival even in the face of disaster. Graham famously emphasized that true risk does not come from market volatility, the up and down motion that terrifies the inexperienced. Risk comes from not knowing what you are doing. Overconfidence blinds, ignorance wounds, impulse destroys. The danger lies not in the market, but in the human mind reacting to the market. This is where Graham's thinking intersects with modern behavioral finance, long before the field existed. He recognized that humans are emotional creatures. They chase trends, exaggerate success, underestimate danger, cling to hope, and panic at the worst possible moments. Diversification is not simply a financial tool, it is a psychological safeguard. Yet Graham warned against blind diversification. Not all assets deserve a place in the portfolio. Spreading money across weak, poorly understood investments is not protection, it is dilution. True diversification means selecting strong businesses, ones whose economic foundations can endure shocks. It means understanding what you own, why you own it, and how each piece fits into the larger structure of safety. In the end, Graham's message resounds with quiet strength. You will be wrong sometimes, and that is exactly why you must build a system that allows you to survive your own mistakes. Through diversification, the investor becomes resilient, balanced, and prepared for the inevitable uncertainties of the economic world. Building enduring wealth, the discipline beyond numbers. Benjamin Graham's final and perhaps most profound contribution to economic thinking lies not only in his formulas or valuation models, but in his philosophy of endurance. To Graham, wealth was never the immediate result of a single lucky investment, but the slow, almost stubborn accumulation of disciplined decisions made over decades. In a world where market noise grows louder every day and flashy speculation captures public attention, Graham's belief in long-term wealth building stands out like a lighthouse in a roaring storm. At the heart of his philosophy is a deceptively simple idea: wealth that lasts must be anchored in principle, not excitement. Graham argued that investors frequently sabotage themselves not because of poor information, but because of poor emotional control. The market, he warned, is a battlefield where fear and greed wage endless war, and the person who cannot master their own emotions will lose long before the economy turns against them. Graham often reminded his students that the most dangerous moment for an investor is not when the market crashes, but when they feel invincible. Periods of easy profits, he said, are when discipline quietly erodes. His personal stories reinforced this. He had seen brilliant analysts rise meteorically only to vanish after a few reckless decisions driven by overconfidence. These dramatic collapses were not exceptions, they were patterns. Graham saw them unfold again and again, like a financial tragedy repeating itself each generation. To counter this, he emphasized the importance of a structured process: clear investment criteria, margin of safety, periodic reassessment, and unshakable patience. He insisted that an investor's real strength lies in the ability to resist reacting, to sit still when others panic, to stay rational when the crowd is swept up by euphoria. In his view, emotional steadiness wasn't simply a personality trait. It was a skill that could be trained, refined, and sharpened over a lifetime. But Graham also issued a warning that still feels startlingly relevant. Financial markets evolve, but human nature does not. New technologies emerge, economic cycles shift, and global strategies change. But fear, greed, impatience, and impulsiveness remain constant. Therefore, only those who build a personal discipline stronger than these forces can create wealth that endures beyond trends and crises. In the end, Graham's message is both challenging and empowering. Wealth is not built in moments, it is built in habits. And the investor who learns to master themselves gains an advantage no market turbulence can ever take away.